Hello, everyone. My name is Gina Ciencio. Welcome to part 3 of our Counterparty Credit Risk Management webinar presented by Double N Advisors, Pangea Business Solutions, and Alliant Insurance Services. Over the next hour, you will hear from 3 experts in this field, Carl Versella, Chris Caruso, and Paul Grassi. At this time, I'm going to turn it over to our presenters. Carl.
Thank you, Gina, and thanks attendees for joining us on this third part of the 3-part webinar that we've started back in May, co-sponsored by 2 of my favorite people on the planet, 2 of DNA's cooperative companies that are part of our ecosystem. Today, we're going to cover recap of what we did in parts 1 and 2, and then go through the evolution lifecycle for CCRM from the perspective of the investment manager in the stage of the lifecycle that they're in. Your presenters today are myself, Carl Versella, and Paul, if you want to say a little bit about yourself, that'd be great, and then Chris. Okay. Chris?
I'll jump in. Hi, I'm Chris Caruso. By way of background, I am the founder and president of Pangea Business Solutions since 2012. It is a consultancy that advises hedge funds on counterparty risks to help them better understand and manage the risks they're taking with their counterparties. Prior to that, I was in the banking business for over 30 years, most of it at Morgan Stanley and Deutsche Bank, and half the time in institutional operations and half the time in prime brokerage.
Paul, a few words.
Thank you, Carl. My name is Paul Grassi. I'm a Senior Vice President with Alliant Insurance Services. I started my career in accounting and was a practicing CPA for about 15 years before entering brokerage, insurance brokerage in the early 2000s, focusing on financial institutions, asset managers of all stripes, private registered investment advisors, private equity funds, and the like. And we put together insurance programs focusing on professional liability, such as E&O, D&O, cyber crime, and the like. Happy to be here. Thank you.
Very good. Thanks, Paul. So just a recap of what we did in parts 1 and 2. Part 1 was basically going over fundamentals of a solid CCRM program, how it affects people, process, and technology, the history and evolution of how CCRM became into being on the investment management side, the functional areas of impact, and some key counterparty agreement takeaways, as we talked a little bit about counterparty documentation. In part 2, we focused on the relationship management and due diligence surrounding how you go about looking at your counterparties, developing those relationships with key people, what kind of due diligence you need to perform on counterparties, and touched a little bit upon counterparty metrics. I think today we just want to recap what we've talked about as the solid goals for an investment manager and what they need to do to have a functional CCRM program. And this goes beyond just having coverage or understanding who the players are at the counterparties. It's really understanding the operational expertise, their service capabilities, and understanding all the risks associated with them. Obviously, the lifeblood of many of investment managers who employ leverage is having a good understanding of their liquidity and optimizing their financing where appropriate. Know your metrics, know who you're dealing with, know what they look like, know how their business is changing, know how their relationships are changing. And providing a two-way street of transparency is clearly important. Be in the best possible position to win with your counterparties, negotiate documents adequately, have optionality and exit strategies in case of certain events. Be able to perform what-if scenarios in a variety of different capacities. We'll touch upon it later on in today's webinar. And obviously creating the right management style reporting for an effective decision process. So building an effective process is going to be broken down into a number of different components for us. First, how do we pull it all together? How do we right size it for your particular organization and look at it from a firm-wide perspective? The second would be, how do I monitor credit metrics and decision processes in a variety of different capacities that we've outlined here, including margin measurement and liquidity analysis, as we talked about, and the coordination of decisions between treasury, risk, collateral, and then the like. In addition, we'll touch upon how we manage and monitor relationship metrics for our key relationships, looking at service provider capabilities, improvement, slippage, trade execution and clearance performance, and a variety of other host of things that we'll talk about today. And then, of course, the last thing that we'll touch upon is vendor solutions. And we broke them out into 5 basic categories: treasury management solutions, asset protection strategies, counterparty documentation management, margin management, and credit metrics and reporting. So let's see how communication, reporting, and functions alike, what an investment manager really needs to look at. And first and foremost, having an understanding of who are the people at the counterparties that we need to talk to. And as you can see, we have a list of a whole bunch of different types of personnel within a counterparty that is important for you as an investment manager to get to understand and relate to and have conversations with. The second main component of course, is the reporting to and fro, being able to provide information to counterparties, but also receiving information from counterparties. And in some cases, that means that you need to share good information with a counterparty or not so good information. It's important to get ahead of the story that you're going to tell, and that you get ahead of the story that the counterparties want to tell. And you'll see that as a main theme that we talk about throughout today. Obviously, functions that are important for the CCRM paradigm outside of getting ahead of the story is performing periodic due diligence. Now, this will vary based upon what life cycle you're in, and we're going to talk about life cycles in a second, but also develop some standards and formalize those standards where you think it's appropriate. And one of the things that we perform with some of our clients is doing peer group assessments and obviously monitoring relationship metrics as we go forward. I think it's important to distinguish, for the purposes of a startup versus an institutional type investment manager, what that actually means in terms of CCRM. And we find that, given our experience and the clients that we've dealt with over the past, that's really driven by 3 main factors. Of course, there are many factors, but 3 main factors are the number of counterparties that you have and you utilize, the types of investors. As they get more complex or more institutional, your ability to service them means that you have to pay more attention to CCRM protocols. And of course, the life cycle of your organization. We've defined the life cycle in 3 main buckets: startups, emerging, and institutional. And from there, if you look at what we mean by startups, it's generally a business that's been in existence for less than 3 years, could be 2 to 3 years. CCRM is somewhat ad hoc. The investors are more seed, friends and family, and maybe fund of funds. And there's generally fewer counterparties. In the emerging area, obviously your AUM is growing, staff and resources are expanding. You've gone through a number of audits, and I think that's a key component to when you start institutionalizing your business. You've gone through 1 or 2 audits. Your CFO and COO are responsible for CCRM, generally speaking. They're a little bit more focused on it. You're gaining more investors and more diversified investors, and the number of counterparties most likely are growing as your business grows. So that's what we define as emerging. There's always overlap between startup and emerging, in terms of where you are in your life cycle. This is not a hard and fast rule, but just some generalities. And obviously, when you get to the institutional side of the equation, you have more mature AUM with more funds and probably more strategies. Your people org chart is more evolved. Resources may be dedicated to CCRM or may not. Generally, you're going to have more counterparties as you're growing. Your organization is more important to your counterparties, so they'll pay attention to you more. And your investor base is certainly more diverse, and your CCRM asks are significant and scheduled. Chris, anything else to add to that page?
Sure, Carl, thank you. The life cycle of a hedge fund is really about a couple of things in addition, or just to amplify what Carl was talking about, is like when you're in the early startup phase or early emerging phase, I mean, you're really focusing on performance and, maintaining, trying to get a business that's going to get its feet under it and be and last. But at the same time, too often you'll speak to startups and early stage emerging managers, and they will be deferring their focus on counterparty risk management for a lot of reasons. Again, focus on performance, resources, people, and money, and the like. But as we're going to talk about as we go through this in more detail, it's important that counterparty risk monitoring and policies and procedures start early, but are right-sized. But you need to be doing something, and we'll talk more about that in a minute.
Thanks, Chris. Very important to think about how we go about right-sizing the business model. Okay, let's move on. So we thought it appropriate to break down the activities that are related to CCRM by life cycle, startup, emerging, and institutional. And as you can see on the page, the first thing we're going to talk about is managing and developing counterparty relationships. Now, these are people relationships. These are people that you get to understand who has an impact or has a strong say in how your business is looked at a particular counterparty. And that can evolve from a senior relationship person to, heads of prime brokerage or credit risk officers. I would strongly suggest that even though we have in the startup cycle, credit and risk offices are more ad hoc in the startup phase, that you get to know those guys earlier in the process, because they're the lifeblood of whether or not your extensions of credit, and in the times of potential stress that you're going to need to talk to. So get in front of them earlier. But as you can see on this page, we sort of stratified, who you would be talking to and when. And Chris, is there anything else that you want to add to this particular page?
Yes, Carl. As we said in the previous page, it's important that that something is being done in the startup space, in the early emerging space, because again, you have to be, doing something. It's not broad. It's probably, it's covering all the bases, but not very deeply. Basically, just to show your operational due diligence vendors and your investors, your prospective investors, that something's being done, right? And the extent of these activities across the life cycle, as we said earlier, is going to be a function of staffing and resources. And so as you move from the various stages, these resources should be, correlating with the growth of counterparties that you're having and your ability to manage them with more structure and effectively as you grow. Carl?
Yeah, and as you can see in the institutional side, it becomes a more formalized process, or it should be a more formalized process. But even in that realm, you'll find that even institutional quality investment managers are still don't have the right size yet and they need outsourcing or they need a support from a vendor. And we'll talk about that as we wrap up this, this activity life cycle. Paul, any other comments on the insurance side, which I think are important to risk mitigation? Paul, you need to unmute.
The insurance piece is somewhat structured around the life cycle of the firm, somewhat structured around the principal's appetite for risk. And as the firm grows and AUM increases, increasingly the investors themselves are going to dictate the levels of insurance that the manager may have. So you start out in the startup phase with worrying about insurance for your physical locations, workers' comp, general liability, auto liability, things and the like. And then as you get into the emerging realm and probably anywhere north of 25 to $50 million in AUM, you want to start looking at your professional lines. That's where the money damages are. That's where the regulatory protections come into place, where anybody who has a stake in anything that you're doing by providing your professional services can, initiate an action, what we call for wrongful acts. And that's what those coverages are designed to protect the manager and any funds that they're managing from.
And Carl,
Thanks, Paul.
Carl, so one more thing that I thought of when you were making your comments was that even though as you're going across the stages here, the organization is evolving, but as Carl said, there's no guarantee that even when you get to the institutional side, you'll have all the structure you need to focus on managing your counterparties. For instance, it's expected that when you're in the institutional phase, you'll actually have a treasurer. Well, that may or may not be the case, right? Depending on the strategy, depending on how the number of counterparties they have and how complex they are, it may not be necessary. That may be handled by the COO or the CFO. But it can still leave, even in the later stages, as Carl was mentioning, something that needs some augmenting by external third parties, outsourcing, and the like, which is, as we've talked about in the previous parts of this webinar, has become much more accepted in the industry than it was probably 10 or 15 years ago.
Yeah, that's a very good point, and something that we'll touch upon when we talk about service providers. Okay, let's move on to monitoring counterparty metrics. So we look at metrics in two basic buckets: metrics that are relationship driven and metrics that are data driven. So we're going to focus on this page on the relationship driven types of activities. And I guess the one thing that we should try to understand about this is when you're communicating and reporting information to your counterparties, what is the frequency? And is the frequency consistent? As an example, if you're sending any information to a prime broker on your monthly NAV performance, they're going to expect that on a monthly basis. In some cases, they may expect it when they pick up the phone and ask you, and you have to be prepared for that. So even in the startup phase, there are certain things that you need to perform, and you need to perform them consistently, because whatever happens with your fund performance, if it's an inconsistent way of communicating, or it happens infrequently or not enough, those are warning flags to the counterparty, and that just raises all sorts of other questions. Why did it take you so long to get us the information? The other thing that I think is important to notate here is getting ahead of the story. And that really means that if something is really happening with your organization that changes the complexity of it, whether it be new ownership, whether it be a name change, whether it be an asset decrease, a significant asset decrease, or vice versa. What you want to be able to do is clearly get ahead of the story before they pick up the phone and speak to you. Because what you'll find is the more you get ahead of the story, the more comfortable counterparties are going to feel about your business and the people that run your business. Chris, anything else to add there?
The point you made about getting ahead of the story also plays back to the previous slide with relationship development and management. And this is another, the key theme that we're going to keep coming back to is kind of right sizing as opposed to deferring, right? And, you may not have the ability as a startup or early stage emerging manager to have a very formal process for monitoring your relationships and understanding the needs of each of these relationships. And certainly when you're dealing with like the hedge fund credit group and things like that, that's really a two-way street. Things have to flow on a regular basis, but also in an ad hoc situation. And being sensitive to the senior relationships, at least in the early stages of being a manager, that will, are the most important, will create the biggest bang for the buck of doing it. You have to kind of pick your spots. And as you evolve, then you have more resources and more structure to kind of expand this. But you certainly want to be able to, as Carl was talking about there, is when it's important for you to be communicating, that always has to be happening across all stages of the life cycle. That cannot be deferred. That is not a nice to have at all. And you'll hear that a lot when you talk to, kind of early stage managers. They'll kind of use that language. Oh, that's nice to have. But, again, you need to be thinking, kind of holistically about this and also about where you're going in this organization. And, certain things, certain priorities cannot be deferred. And in particular, the one that Carl was talking about when you need to get information to the counterparty.
Yeah, I think to add there, we have one of the items here is high priority documentation triggers, NAV triggers, people changes, anything like that. Generally the startup world is less concerned about that because they just want to get documents signed. But the reality is you could be triggering some of these triggers. How do you monitor them? Even in the startup phase, understanding the high priority triggers that will impact what you can do in terms of trading or what kind of business you can be in at a particular counterparty is so critically important. You never want to get that call or that a potential termination event letter that says, we have the right to terminate your positions or your trades because you triggered an event. So understanding that and being able to monitor that, even if it's simplest form of putting it in an Excel spreadsheet, identifying what those high priority documentation triggers are, does have downstream effects. And as you get more institutional, there are tracking mechanisms and alerts that you can create to facilitate that as you get more complex. Okay. Let's move on to counterparty metrics from a data-driven perspective. Again, this is information that's most likely in the public domain. It's information that you can, that's embedded in the information that you receive from the counterparties. In some cases, it's specific to you, but in most cases, it's driven by certain data. Things like stock price, news stories, quarterly earnings. Those are items that anyone can get anytime and be able to understand how their counterparty's business is changing. Unless you're dealing with a private company, most likely you're dealing with an entity that's listed, and you should be looking at these things on a periodic basis to make sure that nothing dramatic is happening to their business that you need to get ahead of. Do I need to pick up the phone and call my relationship person because the stock price, dip, 10% or 15%? What's going on with the company? Basic things that at least give you some comfort that you're qualifying and quantifying your counterparties. So even in the startup phase, you're still seeing these things that you need to do to manage what's going on with your counterparty. As you go further in the curve and you're more emerging or institutional, your ability to do some of these things needs to be more formalized. And again, we've talked about it already in the concept of right sizing. I think it's important to continue that process. And as you evolve and as you may get more counterparties in the emerging phase than you originally expected, let's figure out how we need to manage that. Chris, any other further comments on that?
Yes, Carl, thank you. One of the things that's important, I think, in terms of monitoring, no matter what stage you're at, but certainly at the early stages of startups and early stage emerging managers, is think of it like KYC, kind of know your counterparty. What do you need to keep an eye on? And that can include, events that affect that organization. It can also be events that affect your organization, changes in focus in the business line. Are you a distress manager? Are they going to, you get a sense they're going to start de-emphasizing that business line. And, I used to tell my junior staff when I was in the banking business, take an interest in the organization you work for, right? Understand how they make money, understand what parts of the business are making money and the like. And if that general culture exists at a hedge fund, then the entire organization is thinking about that, is just generally attentive to what's going on. So it's not just the CFO or the COO, but the people throughout the organization. They're involved in a lot of day-to-day activities. If they're taking an interest in the business and have are attentive to changes in anything, even tone on the phone, is something that they should be trying to pick up and playing back through their organization. These are things that startup organizations can do that don't have the resources for a lot of structure. Now, the flip side of this is that, we're not trying to create the impression here is that when you get to the institutional stage that, all your problems are solved. It's actually sometimes less intuitive that even when you get to the institutional stage, the complexity creates capacity issues, right? Everybody's very busy doing lots of things. And even creating structure around counterparty, monitoring counterparty metrics can be a challenge for the larger organizations. And again, that's when they may use external counterparties, whether it's an organization like mine or Carl's or Paul's, but even somebody for compliance or things like that. There's just things that they can take care of because they have capacity issues, and they don't go away completely, no matter what stage of the business you're in.
Yeah, it's a very good point. And again, as your investor base grows and as they do or perform more due diligence on you, these questions will then pop up as an expectation that you're looking at this. Paul, why don't you give us a little bit of color on the insurance side of the equation and how firms should be looking at this as they grow?
Sure. So on the insurance side of things, the counterparty is the insurance carrier. And like any contract with any counterparty, both sides have obligations and responsibilities. We call them terms and conditions. And one of the major ways that a policy is not used properly is when there is a circumstance or potentially a claim, and for whatever reason, that claim is not noticed properly to the insurance carrier. So it's important not to just rely on news reports or leaked information about potential investigations or any potential wrongdoing or lawsuits initiated by anyone. There are certain procedures, and a large amount of claims that are declined are due to inadequate notice. So it's important to, if anyone in the organization that is interacting with clients or other interested stakeholders hears of something, or certainly if there's a letter that is making a demand, you want to be able to look at that policy contract and make sure that you're within the bounds to notice that properly and how that's done. And your broker should be doing it. And there's even like a pre-step to a claim called a circumstance, where you get a letter, they're not quite demanding something, but they're definitely making a statement that they're unhappy about something. And maybe down the road, that turns into a claim. That can be noticed, and you put that action away. At any time, if that develops into a full-blown claim, you've already satisfied your notice requirements. And that's just one of the many terms and conditions. I think folks tend to not realize that the insurance policy is a contract like any other, and there's obligations and responsibilities on both sides to make sure that that policy performs for the benefit of the manager.
It's a very good point. I will make a note also on this page about bottoms-up fundamental analysis. For all you long short guys out there, clearly you understand what that means. You're looking at a company to see whether or not you'd want to invest in it, and investing accordingly, whether it's long or short. Well, the same fundamental analysis can be done with your counterparties. So I would strongly suggest if you're a long short guy and you're dealing with a particular counterparty, that you promote the same kind of due diligence that you would do with a counterparty that you do with your investments. And if you don't have that, that's fine. But at some point, you as you grow, your ability to do that kind of due diligence is going to be more expected by investors rather than less. Okay. Let's move on to monitoring credit metrics and the decision processes. We have a whole bunch of things on this page. What if scenarios, third-party custody activity, liquidity, excess, and buying power. For most funds that employ leverage, this is one of the most misunderstood areas of focus of a CCRM activity. Understanding your margin and how it's measured and how it's reconciled and how it's changed, and understanding your liquidity, excess, and your buying power. Anecdotally, when I worked at Tiger Management, one of the things that we needed to provide to Julian was how much excess do I have? If I wanted to go out and buy a baseball team, how much do I have? And being able to understand how that changed over time was so important, because it gave some insight. Even though the senior PM may not understand margin, it gives them some insight into trends. So I would say that obviously liquidity, excess, and buying power, understanding that on a daily basis, regardless of where you are in the life cycle, is so critically important, because you never want to wake up and find out that you have concentrated positions, the requirements went up, or they decided not to be in a certain strategy or activity. So it's so important to think about those credit metrics that you see happening on a daily basis. With that said, most startups will probably not have a third-party custody provider, and so that's that information is limited. But as you get larger and your need to have more asset protection grows, having a third-party custody provider may be something of interest. And also thinking about what if margin scenarios and what if event scenarios. If such and such happened in my portfolio, first of all, what would performance look like? But secondly, how is it going to impact my counterparties? Am I going to have more or less excess? Are they going to be less inclined to deploy more leverage for me? All of these questions need to be asked. And in the beginning, it's limited as a startup. You should be at least thinking about it and formalizing the process as you go further out. Chris, any other commentary on that?
Yes, Carl, thank you. As you mentioned, a lot that's on here is for more leverage players, more complex players using swaps perhaps and things like that. That being said, it is important to kind of understand, at least, at some level, no matter what your stage is, how your margin works, right? And what are the drivers of it? And certainly, if you look at the examples of even of today's world, where you never know where that next, meme trading direction is going to go, and start and potentially pick off one of the stocks in your portfolio, which could help you or hurt you or whatever. And so you have to kind of understand, as we were talking about what if scenarios and things like that, or what if event scenarios can happen, because there certainly has been enough of them in the first half of 2021 to keep us all on our toes. The other thing to think about is exit strategies. that's something that you're going to see a lot more of with the institutional funds who have the capacity, have multiple counterparties, and are always thinking about moving positions generally between counterparties, but also have some kind of a plan if I have to exit a counterparty or want to exit a counterparty, how am I going to do it, right? Now, that's generally not a focus of startups and early stage emerging managers, but at the same time, there should be, if it's monthly or quarterly, some discussion at some level about, well, if we had to leave this counterparty, where would we go? How would we move? Because they have fewer counterparties right now at this stage. And it's an exercise that is valuable, clearly can't be done as often as the institutional side. But as we've talked about throughout these slides, as you talk to investors, as you prospective investors and ODD professionals, that's going to come up, So again, it's not just, as we talk about nice to haves, these things can affect the capital that you have and can attract, that you have some answer for all the things on this page, certainly not going to be like, the answers in the third column, but there has to be some answers. Carl?
Yeah, that's a good point. And Paul, what would you consider some of the insurance challenges and decision processes that firms would have to go through in their life cycle?
Well, I think as you start out, the basic landlord insurance requirements, like any contract that you might get into, more often than not, there's an insurance requirements section, and you want to make sure that you meet those insurance requirements, whether they're for, a physical facility, bricks and mortar on the ground, or whether they're talking about an E&O policy to protect your professional services and protect them from any actions that they took, particularly if you're going to indemnify them in your contracts. So it's important to go through any kind of indemnifications or insurance requirements that you have with your counterparties and talk it over with your broker to see what kind of coverage you have built into your professional coverages. Perhaps there are some gaps that can be addressed. Some of these will be costs of doing business, but can be minimized. Costs can be minimized by raising retentions, sort of the skin that you have in the game. But I think it's very important to maintain an open dialogue with your insurance broker about the kinds of indemnifications that you're providing to outside third parties, and can some of that risk be transferred to the insurance policies that you have in force, or are other insurance policies available to transfer some or all of that risk? As you grow, that risk becomes more significant, and better detailed analysis needs to happen when you're reviewing contracts, as often as you do, or when you initiate a contract for certain.
Yeah, and additionally, as you alluded to, as you grow, you need to relook at those contracts to see if they're now adequate or they're covering the right people, the right counterparties, the right size, and that's a way, excuse me, of mitigating some of that risk. Okay.
And certainly, just one last thing, Carl, on that. I mean, certainly that agreement point, whether it's the agreements or the policies for insurance, or the agreements that cover your transactions and the products that you use, the terms you get as a startup are nothing like the terms you're probably going to be able to command as an institutional hedge fund. Very highly evolved, very valuable to your counterparties, and it becomes, as you get more legal resources, it becomes kind of an ongoing exercise to make sure that everything is sort of up to the same level, that you're not stuck with a startup level agreement as an institutional client, as an institutional hedge fund.
Right.
And the resources, as your resources are ramping up, you'll have the budget to actually go back and say, okay, well, this needs to be renegotiated and the like, as well as same thing that Paul was saying about the insurance, right? What worked in the first 2 years of our life may not be working in our 10th year.
Okay. As I keep on skipping ahead, let's move on to other activities, specifically as it relates to reporting and communication requirements. And we broke this out into two buckets. reporting and communication requirements of a manager and reporting and communication requirements of your counterparty. So when you look at what your counterparties would be interested in seeing, what are they going to be asking for? And it's important that this evolves over time with counterparties. Some counterparties may be more detail oriented. As an example, liquidity across all counterparties. Some prime brokers want to understand what your leverage gearing is across all your counterparties. Obviously, if they're the only one, it's a pretty simple equation, but they're going to ask for it, and it most likely will be on a monthly basis. But I think the key components, especially that cut across all life cycles, is if you have any change of ownership or any change in legal entity structures. Counterparties do not want to be surprised that there's a legal entity change, even if it's innocuous and it doesn't really affect ownership. It also could trigger a termination event in some of your contracts. So make sure that even if you're a startup, that before it occurs, if it's being contemplated, most likely it's been taking a number of months to get this in order. Make sure your counterparties are aware of it and know that it's coming. Because there may be some additional, logistical paperwork that you need to figure out in order to make sure that it's clean. I'd also say for periodic check-ins, the periodic check-ins will vary depending on who you're speaking to. But when we look at the main periodic check-ins that need to be done, it's probably going to be done from credit and risk. And they're going to want to do a check-in with you to see, how you're doing, what's changed, has your risk profile changed, if anything, in your portfolio? What are you looking like in terms of other counterparties? If they aren't asking this, they should be. And if they are, you should be prepared for it. Chris, any other further commentary on that?
The only thing I would add, Carl, is that as a startup or early emerging manager, you should probably, for these to kind of understand what is required of you, you should leverage your sales coverage, to talk to them about, okay, what do I need to be doing here, right? As opposed to kind of figuring out, because the organizations are all different, maybe it's they'll point, say, the hedge fund credit group is really the group you got to make sure you're on top of here, or the risk group is the one that you really want to maintain a relationship with. So it's important that you have a good sales coverage relationship, someone you can trust, who will kind of help you navigate, at least certainly in the early stages of your life cycle, kind of how to navigate it, who are the people you should be, being proactive with and the like, because again, you have to pick your spots. You don't have unlimited resources here. So that would be something I would make sure you consider.
Excellent. Okay, let's we're getting close to the 10-minute mark, so I want to move forward. Let's talk about reporting and communication requirements of the counterparty. Now, these are things that you will be requesting of them, and one of the basic legal entity structures is the concept of parent guarantees. Parent guarantees should be provided at agreement negotiation. If you're getting parent guarantees, and most firms do provide some of it, understand what that structure is supposed to look like, and understand if there are any changes that occur along the way, because there will be potential changes to that where they may or may not guarantee a particular sub-entity of a parent, and so understanding that and understanding how that potentially affects you, and putting that either in your back pocket or thinking about where else you should go is clearly important. You would hope that changes in coverage and business line focus, that they would be proactive in telling you, but it's not always the case. So make sure that you're aware if all of a sudden you go dark on some of the people that you've been talking to for a while. You can't get a hold of them. Maybe there's a change in coverage. No one has told you. These are nuanced things that anyone can do at any stage of their life cycle, but clearly important because it gives you some indication as to whether or not they're interested, focused, or looking at you. Chris, any other commentary on that?
Well, the one thing I would say about this, Carl, is as you get into the late stage emerging or institutional part of the life cycle, and you become a more important client to your counterparties, then you will have more leverage to conduct more formal due diligence exercises on an annual basis and to extract some of this information that you hopefully got at the beginning of the relationship, but also the big thing about due diligence is to understand the current state of play and what has changed. And if you can create a good due diligence questionnaire that kind of covers a lot of these bases, then you can pull them in. Trade processing changes, financing structure changes, things like parent guarantees, things like that, updated org charts and the like. So those are the things that you'll have more of an opportunity to do later in your life cycle, to again have a standard way of gathering and updating information, because that's really the purpose of it, is that you can say to your partners and you can say to your investors and prospective investors, I'm up to date. I have a process. I know how to keep track of what's going on at my counterparty through this annual process and through, as we talked about in the previous slide, as you get to later stage development, a more robust way of monitoring counterparties on a daily, monthly, and quarterly basis.
Yeah, I think to add to that, clearly investor perception, investor questioning, investor due diligence is clearly a key component. The flip side to that is, are these counterparties paying attention to you? I mean, you could be past the emerging cycle into the institutional cycle and not getting paid attention to for whatever reason, change of coverage, change of business line activity, what have you. You also need to think about, how is this going to impact my business? I got my investors covered. I've checked those boxes, but am I hampered by my ability to do what I need to do from a strategy perspective or from a leverage perspective with my counterparty if they're not paying attention to me? So there are warning signals that everyone should think about when that happens. And so obviously being able to understand those trends over time and understand the story that they're trying to tell you gives you a very good indication as to whether or not they're paying attention. Paul, anything else to add on the insurance side of the equation?
Yes, thank you. I see that the insurance considerations on this page and the requirements of the manager are actually reversed. But when you talk about the counterparty requirements, insurance contracts are one of the rare contracts that a firm will get in, any firm. And at the point where you're executing the contract and required to pay the bill, you haven't actually gotten the contract. So the contract may be months away. You're going to get something called a binder. And the binder has all the relevant documents and most of the terms and conditions that are relevant, and perhaps some endorsement language that's been manuscripted. I can't tell you how many times I go in to do an audit on a policy, and when I review the contract and even the application that the binder was initiated on, there's various differences in terms. And you may be 6 or 8 months or 2 years later, and you found that coverage that you purchased did not find its way into the policy. So it's very important to review those binders that you get on the date that you execute the coverage, that you bind the coverage or renew the coverage against the ultimate contract. That's on the counterparty side. On the manager's side, it's important that everything that you do, every entity that you have is picked up by the insurance contract. So very complex organization structure charts exist with managers. It's important that the broker understands where special purpose vehicles lie. Are they under the holdco, or are they somehow outside with common ownership, but not in the holding company. Insurance is very specific about the entities that are covered. You want to make sure that there's what we call omnibus language that picks up automatically subsidiaries and what specifically defines a subsidiary. It may not necessarily be a majority ownership, but maybe just control. So that's very important, as well as for firms that seat outside board members for portfolio companies and things. You want to make the carriers aware that this individual is sitting at our pleasure on a portfolio company or some other entity, as a subject matter expert or something like that. You want to make sure that the insurance picks up those activities, and they only will if you make them aware of them. So it's very important to be as transparent as possible with what specifically your professional services are and any interactions that you have with outside third parties, and how can those be picked up by your insurance policies.
Those are all very good points and something to consider regardless of where you are in the life cycle. So thank you for that, Paul. Okay, we're going to switch gears and we're going to look at service providers for a second. And I think it's important to understand that based upon our research, our diligence, our ability to have numerous interactions with various service providers, and understanding the landscape, we've kind of bucketed the types of firms that you may come across within, trying to solve the problems for CCRM. And we've defined them here, but let's go through them real quick. So consulting and outsourcing firms like myself, Pangea and others, they can provide subject matter expertise, and they may have outsourcing capabilities where they do the activities on behalf of yourself. That's one bucket. The other bucket is pure custody banks, and that's more on the asset protection side and the ability to be able to leverage custody banks specifically for that. Insurance and insurance carriers, such as what Paul does, that can protect your assets and facilitate risk mitigation. Legal companies that look at counterparty documentation and that look at ways of tracking your risks embedded in your documentation can help you negotiate some of these documents as well. Similar to, what I do, my firm does, as well as what other firms do. There are also technology / outsourcing. That's a wide bucket, but technology companies first that provide ways of mitigating or understanding the risks inherent. It could be in treasury management, it could be in documentation, it could be in a variety of different avenues. Some of them can white label their technologies so they can help you with potential outsourcing. And then there's pure technology companies that provide analytics. This is a data-driven research, information that has come from a variety of different places that have been collated and coordinated specifically to mitigate risk or to provide information so you can make important risk decisions. So those are the types of firms. Chris, anything else you want to add on that side of the fence?
Sure, Carl, thanks. And again, as we play this back against what's been our framework for this webinar is, how can these vendors be used across the life cycle of hedge funds, right? And they're generally going to be used for cost and efficiency, risk mitigation, and in some senses, overlaying all of that is capacity, right? Because even, these are things that you don't have the resources to do yourself, or in a lot of cases, it's a much more, it's a better solution because you don't have to worry about the updating of things like technology and the like. You've got somebody who's providing a service to you, and they're doing all of the upgrades, they're doing all the maintenance and the like. So it becomes a cost and efficiency solution across the stages, and it becomes, obviously certain of them are more risk mitigation focused.
Yeah, it's important to note. On the services that are offered, we've broken it out into 5 pieces of the pie. First being credit metrics, and that's generally those technology analytics companies that can provide you information of wallet analytics, provide what if scenarios, create credit metrics and reporting across your counterparties, so you can get a sense of what they look like across counterparties. I forgot where this information came from. One of those companies that provide these analytics, and I asked them how many prime brokers are out there, and the answer was over 200. And I said, "What? How do you define prime brokers?" Anyone who puts an entity as a prime broker in their ADV is considered a prime broker. So what does that mean in terms of credit metrics and what I should be looking at? There's other analytics companies that then take all of the sub entities and sort of roll it up and say, what do I look like if I was in these 25 sub entities relating to Morgan Stanley? And I just throw out Morgan Stanley because it's a household name. You will find that the credit risk of those sub entities are not the same. And obviously, how do I get all this information? Well, some of these analytic companies are a place to go. Treasury management is a big piece of the CCRM puzzle. There's more and more companies out there that are creating the ability to provide stock loan optimization or counterparty exposure monitoring or treasury and finance fee tracking or fee optimization and the cash collateral management paradigm. All of that falls into the treasury management piece of the pie. And there are companies out there that can handle that. What I will say is that it's all nuanced. They're all slightly different in how they look at it, how they collate, how they gather that information, and how they spit it back out to you. And the ease and use of those types of companies is really driven by performing the appropriate due diligence to see how it fits into your organization. The asset protection strategies, basically insurance companies, custody banks, those that can protect your assets from other creditors, or if they're unencumbered, protect them that way. Counterparty documentation and tracking is basically what it says. These are companies that may provide the negotiation power along with the tracking power. So you understand, when we went back and we talked about what are your high priority risks in counterparty documentation, this is where those companies would help you. And quite frankly, when we look at counterparty documentation, there's over 200 risk factors that we look at in counterparty documentation. How do you track them? And then the last piece is more specialized, but I would say important more for the institutional space as it relates to margin. And margin being the ability to calculate margin, to replicate what margin looks like, to perform collateral optimization scenarios. This really comes into play more so when you have multiple counterparties and you want to be able to arbitrage where your leverage lies. But even for those that are large that only have a few, understanding those changes is what these margin engines do. Chris, any other commentary on that?
Carl, the only thing I would add is that no matter what your needs are and no matter what stage of life cycle you're in, don't assume you can't afford these vendors. Find out some of these vendors do provide, price points that work across the hedge fund life cycle. So these are not just services that the institutional hedge funds are taking advantage of. So again, I would encourage, as a follow-up here, if you do reach out to any of these types of companies and the like, find out if they do have kind of, these structured pricing packages that can avail themselves to earlier stage hedge funds.
Yeah, it's an important point, and because technology has gotten so much better over the years, the ability to scale up or down with these companies is becoming more palatable and more easier for funds to look at. Okay, we're getting towards the end, and we're past our hour mark, so we're going to do this quick. But pulling it all together takes a variety of different things. Make sure that you're planning, regardless of your cycle, right size, as we've talked about, define the metrics that are important to you, perform active management and ongoing due diligence, create standards for periodic analysis and stick to them, understand the trends over time with your counterparties and yourselves, understand how the service offering is changing. And one of the most important things is understanding the story for each counterparty and defining your own story. So know your story, be able to tell it, and know their story and be able to articulate it. And then you'll be in better shape to know that part of this is art and part of this is science. And with that, if you have any questions about anything that we covered in the last 3 webinars, or if you're interested in learning more about our companies, please feel free to touch base with us either on LinkedIn or through our contact information. We thank you all for sticking with us for the last hour, and we wish you all the best, and thanks for joining.
Thank you, everyone.
Thank you.